Scott. Yeah, it looks like markets are positioned and to rally into year end. I think investors have to be aware that the bond market this week really started to deliver signals that are strengthening this rally. I think that's why there's been this improved resilience.
The 10-year falling, what's the message there, do you think? Because it's a surprise to many, I think, for obvious reasons.
That's right. The 10-year yield falling is a dovish development because over the past 8 weeks, the bond market was starting to fight the Fed view. As you know, the bond market was starting to push for rates, 2 hikes or 3 hikes in 2022, and then a tapering that was causing pressure upwards on yields. And I think the weak GDP print, the productivity miss, and then this pill from Pfizer are really starting to take away that inflationary pressure. And it now looks like the bond market's coming to the Fed's view, which is great news because that means that if yields are falling and there's less inflation fears, equities have room to run.
Tom, let me ask you this. Let me try and sort of get inside the mind of Tom Lee, bring our viewers inside there as well, if I could. What led you to believe that stocks could hit 4,800 on the S&P by the end of this year? What enabled you to get so bullish when you did, that you thought we could get that so-called everything rally that seems to be happening as we speak?
It's anchored on 4 things. One was, our continued belief that S&P profit margins would surprise because of what we call the unkillability. Businesses survived the worst shutdown in 7 generations. And when we saw this in tech and discretionary, margins really rose, and that's what's happening. We think S&P earnings next year could be 230, 240 versus 220 consensus. The second is we know there's tons of pent-up demand, and that if COVID was alleviating, that would start to be unleashed, and we're seeing that. The third is relative value because, bonds are expensive. You're paying 64 times earnings to get a 10-year, 25 times to get high yield, or you can pay 18 times for equity. So I think equities are still cheap. And the fourth is just from a general positioning, many of our clients, not most, but many, are sitting on very uncomfortable cash positions. And they've been waiting for that 10% pullback. Not that we've been calling for it, but they've all had that as a consensus view, thinking the Fed was going to trigger it. And now that it doesn't look like it's happening, that money gets put to work.
Well, look, I always try and play devil's advocate with you. And admittedly, I'm running out of material, to be frank. However, if I say to you, that all sounds great, I believe the story that you tell, and so do people who are watching, but earnings growth is going to slow, and the Fed is going to raise rates. And not only is it going to raise rates, Tom, it's going to raise rates earlier than we thought, not even 3-4 months ago. And it's going to raise rates sooner and more rapidly, more consecutively than we expected as well just a short time ago. Isn't that going to depress the market, depress multiples in any way?
Yes, Scott, that's correct. We have to be realistic. The Fed remains the most powerful entity in the world when it comes to financial markets. And a tightening cycle ultimately triggers equity volatility. So you're absolutely right. If the Fed is indeed going to be tightening next year, we should expect a lot of turbulence because people are going to be fearful. But the Fed futures market in the past week have shown the odds of a hike are actually decreasing. So I think the supply chain glitch is easing. The Fed's argument that monetary policy can't fix the labor tightness because it's not about an overheated economy. I think if the market starts to believe it, the actual window for hikes is getting pushed out again into 2023.
Are we just being too simplistic in saying it literally is an everything rally, Tom, that people should buy every major sector for lack of more specificity on that? Or do you really have to be more specific? Do you like certain areas other than other ones?
Well, I think where strength is beginning to really show is in FANG. So FANG is our top 2 of the 3 sectors we'd want to own. And I think they are starting to show a lot of resilience because they derated this year and they've had great numbers. But I do think that today's response to the Pfizer news shows that cyclicals, especially epicenter stocks like travel, leisure, energy, are super sensitive to the market's view about COVID. And as that's getting better, we know that people don't own enough of these. And so I think you want to be epicenter and FANG.
Let's get the committee involved, and we'll do it quick because I want to move on. But I do want to get their view. Bryn, You agree with Tom Lee?
Yeah, well, I mean, kudos to Tom Lee. He's always been a force here of comfort, you know, since this all started. I do have a quick question. You know, you talk about the epicenter names. You know, I obviously like energy. I think it's been structurally underinvested in, and so therefore we'll have some secular tailwinds. I'd love to get your thoughts about energy, you know, short and midterm from a portfolio perspective.
Yeah, it's a great question. I mean, to me, the best analogy is energy looked like the home builders post GFC. You've got a structural shortfall of oil production being set up that will take multiple years to fix. That's price support for oil above 80. You know, even we've done some work. You know, you have to get to $150 to $200 oil to really start to pinch the wallet. And then energy stocks are still cheap to oil, mainly because people have avoided them from an ESG perspective. But their performance impact has been so great. People can't ignore it. And then if it turns out like home builders, you know, home builders were a secular trade for 9 years. And I think there's a chance energy is a 5-year, 6-year secular trade.
Tom, before I let you go, you still comfortable with 4,800, your year-end target for S&P?
We're entering the 6 weeks that matter the most, you know, and then people will start talking about Santa Claus rally. So I think 4,800 is maybe the minimum. I think 5,000 is more of a early 2023 or 2022, but I think easily 4,800 is achievable. You know, I mean, I'd say seasonals tell us it's 5 or 6% upside from here. Boy,
5,000 in early 22. We'll see. I appreciate it as always, Tom. I know our viewers do as well. It's good to see you. Thanks for jumping on with us.